Holy smokers, this video today ain't no jokers. This is an absolute beast of a video here today I got for you guys. What a banger, okay? Alrighty, so public count up about $59,000 here today. A good day for the public count. This account's been in an absolute war recently. I mean, it's been battling with that $4 million line for like the past month or two. It'll go, 4.1 mil, maybe 4.2 mil, then it goes back down to 3.8, 3.9. It's been an absolute battle. Meanwhile, people are still hitting all-time highs out there in their portfolios. Just last week, we had 4 people in the private stock group hit 7 figures, and we had 8 people hit 6 figures in their portfolio. So congratulations to everybody out there hitting new all-time highs in your portfolios. I obviously love to see it. Okay, we got a lot to get into in this video here today, ladies and gentlemen. Okay, Revolve stock was a huge mover for me here today, up double-digit percentages, up $4,800 on the stock, now up 100% on the stock in the public count. We're going to talk about Revolve, what's going on there with that company. Fubo moved up very nicely here today. That stock was up double-digit percent, up $8,000, up $36,000 on the stock now in the public count, over $4 a share. So we'll speak about Fubo, where that stock's headed from here. AMD, they wanted to send this one down. AMD, they wanted to send it down so bad. And yet that stock still found a way to be green, up $16,000 plus on the stock here today, up $370,000 on that stock now at this point in time in the public count. We'll speak about AMD, where that stock's headed. SoFi, this one continues to show strength. Continues. It's unbelievable now, sitting at a 262% move, up $108,000. We'll speak about SoFi in this video here today. Shopify is my second biggest position in my Patreon portfolio, not the public account, but in the Patreon portfolio, right? I don't talk a lot about Shopify, but this one continues to move up. I want to speak about Shopify in this video as well. My gosh, do we have a lot to get into. Honest Company reported earnings. I got to share my opinions and perspectives on Honest earnings, what's going on there. There's a brand new stock I just bought for the first time ever. We're going to speak about that, why I'm buying that stock in this video here today. And then Elf earnings hit here today. That's been an amazing gainer for me over the years, sitting on a 1,500% gain on Elf stock. They had their earnings. I'm going to share my opinions and perspectives where that company's headed, where stock price is headed. Is this an opportunity? Is it not? Oh my gosh, ladies and gentlemen. I hope you enjoy this one here today. There's one thing, and there's one thing only I need from you. If you could please just hit that like button. And for every single person that's already done that, you are my hero. That's all I ask for today's payment. Okay, just a thumbs up, okay? If you want to be subscribed here to the channel, you can certainly subscribe. We are well over 900,000 subscribers here on the channel now at this point in time. For the pinned comment down there today, I'm going to put the application if you're looking to apply to join my private stock group, private wealth group, all that good stuff. Remember, January 1st, we're moving to $100,000 minimum net worth to join in there. So if you're under 100K net worth, you might want to get in there before January 1st. And also, we have our new lifetime membership card for anybody that joins on a lifetime membership. Usually just get your Steel membership card for 1000X and your private group Steel membership card. But now if you're a lifetime member, you get the black card as well. So do keep that in mind. And then we're now up to 2,849 members of the private group. So I'm thinking about potentially closing the private group to new members when we hit 3,000 and then opening it back up at some point in time in, let's call it 2026. The demand's been overwhelming in there. Just yesterday, we received another 100 applications after receiving 500 applications last week. It's been ridiculous. So that's going on there. Pinned comment down there if you're looking to join us in there, okay? Already, Revolve. Okay, here we go, ladies and gentlemen. Man, do we got a lot to go through in this one here today, okay? Listen, in regards to Revolve, this is very important. I do not talk a lot about this company, but listen. This is a company in the e-commerce space, very successful selling clothes, okay? And we can call it $300-ish average orders. And so very heavy female demographic as well. And this is a company where, they were kind of a dead stock. Then they were a beautiful stock. Then we went through inflation and all the drama in 2022, 2023, right? That really brought down this company. But man, the company finds a way to just execute. Their net sales were up 4% year over year for this company, even despite everything going on out there in the world, right? Gross profit was up 11%. And net income was up 97%. I put this in the private group. I said, I love to see my company's revenue growing, gross profit dollar growing even at a faster clip, and net income growing even faster than that. And that's exactly what we have with Revolve here, okay? Remember, Revolve has one of the best balance sheets in the entire world, ladies and gentlemen. In the entire world. Like, Phenomenal balance sheet of this company, and it's a very small cap company too. It's not like this is some massive company. This is like about a $1.5 billion market cap, and they have over $300 million of cash and cash equivalents on that balance sheet. And it's incredible. $251 million of total assets versus $291 million in total liabilities. The income statement looks great for this company overall. So Revolve is a very good company with a good management team, and they continue to execute and come in through with numbers. And so there's brighter days ahead for Revolve, and I can see why it had momentum today. It's a stock I'm happy to be a shareholder of. And yeah, their income statement was really good. I didn't include it in here. I have it in the private group, in terms of the grade and whatnot, but it was a good grade. It was impressive, man. Like very, very impressive overall. I think I graded them a B+, if I recall, for Revolve. So really good company. I don't talk about it a lot. It is a stock I own, and it's a good company. Like, doubled up with my money on it, and I wouldn't be surprised if I end up tripling up, quadrupling up my money on that stock over the next few years, okay? Fubo, next one up here. This is a speculative stock I have. That this stock continues to get less and less speculative as I've owned it over time. Obviously broke the $4 barrier here today, and now up over 80% on the stock. I think this is the next stock in the public count to basically get us a triple-digit gain. Revolve is the seventh stock in the public account to active position to be up 100% plus on. I think Fubo's next up. I think that will be my eighth stock with a triple-digit gain or more that's an active position in the public account, okay? So here's the deal with Fubo, okay? I don't know if you guys got to see my AMD video on the reaction channel last night called Jeremy Lefebvre Makes Money. But that video, I reacted to Alex Karp interview, I reacted to a Tom Lee clip, and obviously I spoke in depth about AMD's earnings and my feelings and those sorts of things. But in that video, I threw in Fubo as well, okay? So that's why you always want to make sure to watch my videos, because I'm going to throw other subjects in outside of just whatever the main title is, right? And basically in that video, I said, you know what I said? I said, it's a crime that stock is under $5. I'm talking about Fubo, right? It's an absolute crime. Like, the way that company's executing, there's no way that stock should be under $5. We could debate whether it should be 5 or 7 or 10 or 12 or $15. That's a free debate. But I do not think there's any way you can justify that stock being under $5. Given the deals gone through now, given the balance sheet, the connections with Disney, like, I'm just like, no. There's no way conceivable that stock should be under $5 right now. So, don't be surprised if you see that one over 5 sooner rather than later in regards to that stock. And the bottom line is it's less speculative than it's ever been in the company's history, right? And so it doesn't belong in the gulag. It does not belong in the gulag, okay? AMD. So AMD, they wanted to send this one down. They couldn't send it down. AMD remains a very resilient, strong stock. One of the strongest stocks in the market, despite everything going on out there. Like, AMD holds up very, very well. And it's really because of what this company has coming over the next few years, right? When I put my bull case, base case, and bear case together, my bull case, usually I would put it like a 10% probability, something around my bull case happens. Base case, I put around an 80% probability, something like that happens. And my bear case, around a 10% probability, something happens, right? Look at this bull case for AMD, okay? In my bull case for AMD, I had them growing 40% revenues per year. Keep in mind, 2026 to 2029, I would say all their business lines should be growing. Every single business line they have. But the data center business is going to be insane, because that MI400 series, which really that 450 series goes into production late next year, right? Well, second half of next year. That's going to be a blow off top for the business. And that's going to run all the way through into 27 and likely into 28 as well, right? So in my bull case, I had them growing 40% revenues, 50% net incomes. That puts the stock, where it puts it in 2029? At an $845 stock to $1,100 stock. Smoking. What about my base case for AMD? This is what I expect. So this is just a fancy way of saying, like, AMD's numbers will likely be somewhere around what I have here for my base case, in my opinion at least, right? And then doing 35% revenue growth on average, 26 to 29. 45% net income growth on average, 26 to 29. I have that stock going $670 to $800, right? Which gives me a strong compounded annual growth rate of probably around 30%. This, ladies and gentlemen, is why I built AMD into one of my biggest positions. And this, ladies and gentlemen, is why you're seeing momentum in this stock continue. Because if my base case comes true here, right, how many other stocks in the market over the next 4 years are going to give you a compounded annual growth rate well into the 20s, if not 30% plus? In a realistic base case, there's not many, if any. That's a one of one. So that's why that stock continues to see momentum despite the market, despite sell-offs and AI fear and bubble and this and that. Like AMD's a one-on-one story and a one-on-one situation going on, and the story just gets better and better. That's the best thing. Like the story's better now than it certainly was a year ago, and guess what? The story a year from now is going to be dramatically better than it is right now. So, and then its story even a year from that will be even better. So that's the beautiful thing with AMD. Now, my 10% probability of bear case if things went really bad for AMD, right? Basically, the stock would be a money loser between now and 2029. But that case has them growing revenue at only 20% clip per year, which I don't see that. Like with how much demand there's going to be for that 450 series, I just don't see that being realistic at all, right? But it could be a dead stock for 4 years if they didn't grow strong, right? But I think 35% revenue growth on average should be very realistic for this company overall, right? Next one up here, SoFi. SoFi stock continues to see momentum time and time again, right? And this is one you think would be a pullback. You see some Russell weakness out there from time to time. You see like overall fears of this, fears of that, fears around even like a lot of these hot stocks that have been hot, right? Like margin calls coming for retail investors and all this stuff, right? And at the end of the day, SoFi continues to just show strength and strength and strength, right? And for all of us that were buying the stock back when it was a single digit stock, like just a year ago, we've made great money. Congratulations to everybody out there, right? But here's the deal. If you want to, like, my personal opinion is SoFi is the most exciting company in fintech, period. Now, if you look over the past year, you would say Hood is the most exciting company in fintech. And I would say over the past year, that's a fair statement, right? But you got to understand in regards to Hood, and this is no shots at Hood, this is no hate at Hood, right? But somebody's got to be the most exciting, right? And I think we've really flipped here on what stock is the most exciting in fintech and could provide the best returns moving forward, right? The thing with Hood is, Hood over the past year has really benefited from the massive amount of retail investors that have gotten in the market. We've seen margin go through the roof, right? Bitcoin obviously went on a huge run. Now we see stocks kind of weakening, right? We see Bitcoin certainly has weakened dramatically, and margin levels are probably topping out right now, at least for a period of time. And how does Robinhood make a lot of money? They make a lot of money from people buying and selling a lot of stocks in Bitcoin and Ethereum and margin, all those sorts of things, right? So now we're in a period where we feel like we're kind of flattening that out, right? And so that makes it a little bit tougher of a position. And so what we witnessed over the past month, you see that 1 year is insane, right? Here's the 1 month for Hood versus SoFi. Over the past month, Hood's down 3%. Now that does not include Hood is down after hours right now as well. Do keep that in mind. So Hood's return could be less than this. But I was just taking it from where it was at today. 3% down in the past month versus SoFi's up 18%. We've had a huge flip there, and it's kind of a changing of the guard in terms of what's the most exciting fintech and which one, or people really want to be in over the next year, next 2 years, and things like that, right? SoFi's much less reliant on stocks and crypto and stuff like that. They're much more reliant on traditional banking and attracting those sorts of customers, which are extremely valuable customers. And that's not to say Robinhood's customers are not, important as well. It's just it's a different level of importance with your customers when your customer base has their bank accounts, right? When your customer base is taking out a home loan, a car loan, a personal loan, like that's a different customer relationship there. And there's a reason, JP Morgan is a $1 trillion giant, right? And Fidelity's not. Like Fidelity Investments, I love Fidelity Investments. They've grown into such a giant, beautiful company. But at the end of the day, there's one JP Morgan. And, so keep in mind, who could be bigger long-term? Don't be surprised if SoFi is a larger company long-term. If Anthony Noto executes the way I think he can over the next 5-10 years, you could actually see SoFi actually be a bigger company than Hood. And that would be kind of shocking to people right now because people don't even, couldn't even conceive that being a possibility, right? Oh, we'll see, okay? Now, in terms of Shopify, this is the second biggest position for me in my Patreon portfolio. Almost a 10% position. I don't talk about Shopify a lot, but it's been a great performer, up 146%. In the Patreon portfolio, one of my better stocks out there in the Patreon portfolio. Here's the deal with Shopify. And honestly, this is a stock that I feel like there's two companies that almost everybody should own. One is Amazon, one is Shopify, right? I could make strong arguments that everybody should own either Meta or Google or both as well, Okay, like those to be like non-negotiable. You gotta own Meta, you gotta own Google, you gotta own Amazon, you gotta own Shopify. Okay, so here's the deal with Shopify. They just grew revenue 32% year over year. They've done now 1.4 trillion in global commerce since Shopify came about. No one ever even heard of Shopify 10 years ago. It's incredible, right? Around 12% US e-commerce market share. Now they're available to millions of merchants in 175 plus countries. Obviously, they have a ton of small businesses and mid-sized businesses that use Shopify, right? We know that's a place Shopify really dominates. Small businesses, mid-sized businesses, but a lot of large companies now are creating Shopify as their back end as well, including two companies I personally own. Elf, which we're going to talk about in this video here today, and Estee Lauder. Both of those did deals with Shopify. So keep in mind, Shopify is the company for not only small businesses, not only mid-sized businesses, but large companies as well. And they're continuing to land more and more. And don't be surprised if that continues to build over the next several years. Now, when it comes to Shopify's income statement here, a little bit of a mixed bag. That's why I gave them a B- here. Great revenue growth, obviously, from the company, 2.1 billion to 2.8 billion. Remember, this is an asset-light company. So keep in mind the revenues will always look a lot smaller than somebody that's asset-heavy, like let's say Walmart. Somebody that's asset-heavy like Amazon, for instance. Those companies' revenues are going to be crazy. Shopify is more of a software play and much more of the best way I could put it is just it's asset light. Okay, so their revenues are never going to be the type of big numbers that you're like, oh my gosh, like Amazon could do $200 billion of revenue in a quarter, right? That's not going to be Shopify. But Shopify, what they could do is long term be ridiculously profitable and be able to throw billions of dollars a quarter off in basically net income long term, right? So great revenue growth, 30% plus for the company. Gross profit went to right around $1.4 billion from $1.1 billion. Merchant Solutions was a little high as far as that cost of revenues there. That was, we can call that growth of what? 35, 40%, somewhere in there roughly. Sales and marketing went up quite a bit, 410 mil versus 331. Transaction and loan losses here. That was a big increase year over year. $148 million. Oof. From $58 million. So that definitely hurt the operating expense line item. So operating expenses went to a little over $1 billion from $800 million in the same quarter last year. Even despite that, operating income still increased to 343 mil from 283 mil. They had a one-off last year that made their net income look way better than it was essentially. They did not have that in this particular quarter. So net income, excluding the impact of equity investments, $367 million for the company overall. The thing you got to understand about Shopify is Shopify doesn't get talked about in the same sentence as many of the Mag 7s, right? nvidia, Apple, Microsoft, Google, Amazon, Meta, Tesla, those sorts of companies, right? But you actually look at this company since it went IPO about 10 years ago, and it's actually been it's actually outperformed almost all of them except nvidia. nvidia is the big dog, right? Over the past roughly 10 years since Shopify went IPO, nvidia stock is up a shocking 35,000%. Okay, but you know how much Shopify's up? A very impressive 5,800%. 5,800%. Tesla, which you would think has been, up there with Shopify, it's actually not. Tesla's up about 2,600% over that time. Amazon's up a little over 1,000%. Microsoft's up about 1,000% as well. Google's up a little under 1,000%, and then Apple and Meta are in the 700% range, right? So Shopify doesn't get talked about that much, man, but it should be. It honestly should be. Speaking about honest, there's honest, okay? Let's talk a little honest. What's going on here with this company? All right, so this one's a complicated one, okay? Because they've got a lot of changes going on with their business model we'll talk about here in just a moment. I graded them a C- for their income statement over here. Revenue went to $92 million from $99 million. Cost of revenue fell about $2 million year over year, so you wanted to see that number down bigger than that considering the revenue being down, right? Gross profit, $34 million versus $38 million. Selling general administrative, this was actually very impressive. They brought that number down substantially. That was $23 million in the same quarter last year. They brought it down to $17 million. So if your revenues are going to go down, you better bring your SG&A down considerably, right? Marketing, though, I didn't like to see that marketing line item. That was up quite a bit year over year from $13.1 million to $14.7 million, right? I didn't like seeing that. And the reason being is revenue didn't grow in the quarter. I don't want to see my companies having revenue shrink, but your marketing expense went up. Okay, if they would have brought marketing down a lot, then I would have said, okay, fair play, right? Then maybe that's why their revenue was down. So total operating expenses, it did fall for the company year over year. So they actually were able to increase operating income despite revenue being down, we can call it, close to $7 million year over year. That's actually pretty rare. And with all the tariffs going on and all that drama, like it's actually pretty impressive that they were able to grow their operating income despite revenue being down almost 7 million, despite the tariffs and all that drama, right? So diluted EPS grew on a year-over-year basis, net income grew on a year-over-year basis, but kind of small numbers there, right? Balance sheet looks amazing, $71 million plus in cash and cash equivalents. They have more, this is insane for honest. They have more in cash and cash equivalents than their entire total liabilities. You almost never see that with a company. It's extremely rare for you to see a company with, they have $20 million more in cash and cash equivalents than if their entire total liabilities put together. Ridiculous. Like, Honest is the strongest, this is like a $300 million market cap, a little over $300 million market cap, right? When they're sitting on that sort of cash level, in this sort of balance sheet at a $300-ish million market cap, that's ridiculous, man. A one-on-one balance sheet for this company, no doubt, right? No, they're doing some major changes to their business model. It's called Transformation 2.0 with the company. Keep in mind, Transformation 1.0 went phenomenal. Like Carla, and the team has, basically transformed this business from a dead company, a company that looked like they were going to go bankrupt, into now a company that we talk about the balance sheet being like legendary balance sheet, talking about a company that's now profitable, right? Has margins stable, all those sorts of things. So now they're taking things to the next phase, Transformation 2.0. The revenue for product categories or channels that they're exiting, right, are accounted for 22 to 21% respectively of their revenue for the 3 and 9 months ended September 30th. So basically they're going to be getting out of some products, right, that are likely taking the company's focus away from other products that could actually be game changers. There's probably some products, this is my guess here, okay? There's probably some products that Honest is selling right now that are not bringing any profitability, or maybe even arguably losing the company money, right, and are hurting the margins substantially. When they could just get out, and it's a tough position to be in if you're Carla, right? Because you're looking and you're like, okay, if I get out of these businesses that are drags in the business from a margin perspective and profitability perspective, right, I could likely set the company up for a much better next 5 and 10 years, right? But there's short-term pain you have to go through over the next 12 months because your revenues are going to go down. Like, there's no disputing that. Like, it's pretty much impossible for the revenues to go up when you're getting out of several product categories that are big product categories for you, right? And so something to just keep in mind here is revenue is not going to be exciting at Honest for the next year, basically. They're going to have downtrending revenues for a year. But with that being said, the business is likely going to get a lot healthier. And what they're going to build out into after that essentially is a company where margins could go to records that we've never seen in this company's history since they've been a public company. We could see that net income and the earnings per share go to numbers that we never thought possible, right? And this is going to allow them to put more resources behind the products that actually have real potential to really grow this business substantially in terms of revenues, in terms of profitability and things like that, right? My guess is they're going to lean heavier on cosmetics, beauty products, right? Maybe their core baby business and things like that. That's my guess. And maybe they're going to exit some other product categories that just, or certain products in product categories that just aren't moving volume, right? And are just distracting the company, taking their margins down, taking their profitability down, right? And then you got to have employees that help run it. And at the end of the day, it doesn't make sense, right? Like, you could have revenue just for revenue, but at the end of the day, if you're just growing revenue for revenue's sake, it doesn't make sense, right? So the deal is, I don't know where the stock will be at tomorrow, but maybe it'll be at like a $330 million market cap or so, right? I think what Carla is doing here, I think, one, she's making these moves because it's likely going to position Honest much better for the next 3, 5, 7 years. But the other strategic thing she could be doing here, ladies and gentlemen, okay? I've been in this market 17 years. I've seen a lot of things, okay? She could be positioning the company to eventually sell this to a big company, okay? I don't know who. Do they want to sell it to a Kimberly-Clark? I don't know. Kimberly-Clark just did that Kenvue deal. I'm not sure about that. Do they want to sell it to a Procter & Gamble over time, or a Johnson & Johnson, or whoever, right? There's a lot of different options out there. Maybe they could even go to like a private equity fund or something like that. There's always a potential that maybe Carla and the team want to sell the business, right? And so if they do that, they want to position the operations to be as lean and profitable as possible. Because if you're coming in to buy Honest, let's say, right, and you're coming in thinking you're going to pay $500 million or $700 million for the company. One, you want a clean balance sheet. Then it makes it a lot easier to sell the company if you got a clean balance sheet. Honest is debt free and they get loaded with cash to the sky. So let's say you pay $500 million for Honest, $700 million, whatever, right? You're also then getting $70 million back in cash. Now, assuming it's 1 to 2 years in the future, the cash level will probably be even bigger, right? Who knows what their cash levels are there? Maybe it's $80 million or $100 million. So you're actually technically paying way less than whatever the dollar amount you announce is, right? And you're not having to worry about, oh crap, we have to take a big debt load on at high interest rates, right? And then you could also grow your company's revenues and then get into a lot of these product categories that Honest is very successful in, selling to a lot of the millennials, Gen Z and things like that, right? So she could be positioning the company for that and maybe an exit, right? Which, she would make everybody a lot of money in the end. Like if she did sell this company, let's say they sold it, a year or two from now for like $700 million or whatever, she'd make herself a lot of money. She'd make all the other executives a lot of money, and she'd make obviously shareholders like me and maybe some others a lot of money. But that might not be the route. Like maybe her ambitions are really to grow this to be a $1 billion company or a multi-billion dollar company long term, right? That could be her ambition as well. But regardless, whatever she's going to try to pull off here, it's better to position the company the way she's positioned it, right? So just don't be excited about Honest's revenues for the next, 4 quarters. Honest's revenues are going to, suck for the next 4 quarters. But that doesn't mean profitability will suck, and that doesn't mean margins will suck. So do keep that in mind, okay? And in terms of me, I have full trust in Carla making this move. Full trust. Like seeing she took this company from they were on their way to bankruptcy, it was a $1 stock, to seeing to where it's at now with this balance sheet, with the income statement, they're profitable, they have money to the sky. Like I trust her. I trust her in regards to this, right? Alrighty, next up here, new stock I just bought. First time ever. What stock do you think it is? Think it's Pepsi? No, it's not Pepsi, okay? You know what it is? It's going to surprise some of you guys. You're going to be like, what? That stock? Interesting. It's what it is. American Express. Ticker symbol AXP. It's a $365 stock here today. I've started a position in the public account. I've also started a position in at least one of my private portfolios, if I recall, if not 2 of my private portfolios now at this point in time, okay? So, American Express, I love this stock, okay? Obviously, we all know American Express. Like, if you're watching this right now, I'll almost guarantee you 98% of people watching this right now, you've heard of American Express, if not 99%, right? Credit card company, they make the fees, right? Additionally, you pay fees to American Express, and they give you a bunch of perks and features and things like that. Incredibly successful business, right? And, if you're higher income, higher net worth, good chance you use American Express, right? So American Express, here are my numbers for this company, right? I've done a 10% revenue growth under my bull case, right? 10% probability this plays out. 15% net income growth. If that happens, the stock goes to $800 to, let's call it $950 by 2029, right? Or in 2029, which right now a $365 stock, that's a very strong 20% plus CAGR here, right? My 8% probability base case here, this has them growing revenues at 8% per year on average, 2026 to 2029. 12% net income growth, right? 28 to 33 PE, which would be very fair for a sticky business model like this. And that would put the stock somewhere just under $700 to potentially $800 come 2029, right? Keep in mind, American Express buys back a ton of shares. So what you're not seeing in these intermediate projections is they bring down the share count substantially over the next 4 years, right? Which makes their earnings per share go up at a way faster clip than, let's say, 12%. Maybe it goes up at 15%, 20% clip a year, right? On average, which then you can say maybe the stock price might go more towards $700 to $900 in that scenario. Something to keep in mind here, okay? And then even under my bear case scenarios, guess what happens? I make money. I mean, even under my bear case, only 5% revenue growth and only 8% net income growth, which would be bad for Amex to do this over the next 4 years. Even under that scenario, I get a compounded annual growth rate of 4 to 10%. When I can run numbers on a company and I'm going to get my base case around a 20% CAGR, and I can run a bear case and I still make money, I can't sit on my hands and not buy that stock, because there's not a lot of companies that's possible with, right? I even ran you through AMD. AMD's, got so much upside potential, right? But in AMD, my bear case has me losing money. So it's more of a risk. When I run numbers on an American Express and I make massive returns under my bull case, I make 20% type CAGR under my base case, and then I still make money under my bear case, I'm going to buy that stock. And that's why I've started a position in American Express, because I'm just like, the stock is too attractively priced right now. Additionally, American Express pays a quarterly dividend every 3 months to everybody, okay? Look at American Express's revenue over time, right? That's the type of revenue growth you want from a company. Obviously, the really big growth here was coming back of travel, right? Travel coming back. But this is where we're at right now. That's what I love to see from a company, right? Trailing 12-month earnings per share. Look at that, baby. That's where we're at right now. This is where we're headed under that earnings per share growth. Shareholder equity continues to increase for this company, and look at shares outstanding. Remember, American Express produces unbelievable cash flows, right? Unbelievable cash flows. Such a profitable business model, and just gets more profitable every year. What do you do if you're American Express? You've got all this money pouring in all the time. You might do a tuck-in acquisition here or there, but you're not going to do some massive acquisition, because a lot of times the government's blocked that. It's not like American Express could say, I want to go buy MasterCard or something like that. Like, it would get blocked, right? Or we're going to go combine with Visa. Like, no. So what do you do with all your money? You do share buybacks with them. And so what American Express is doing is they're basically keep compressing the amount of shares outstanding and keep bringing it down and bringing it down. And I honestly don't see that slowing or stopping anytime soon. And as a company gets more and more profitable, guess what? They're going to be able to buy more shares back, more shares back, more shares back, right? And so it's just a beautiful situation with American Express. And sometimes you just need to own a stock that's just stress-free, and you're going to be able to make a lot of money. And that's American Express, right? I had a fancy AI, Google Gemini, make this photo for me, this guy looking at the ocean. And that's American Express shareholders right there. Like, you just make money and make money and make money and make money. And it's just sometimes like those stress-free stocks. Is American Express the most exciting, sexiest stock in the market? Oh my gosh. Oh, they're going to Mars. They're going to go mine on Mars, and they're going to mine in the ocean. They're going to pull out rare minerals. No, okay. No. But at the end of the day, it's a huge moneymaker. And at the end of the day, if you get an opportunity to make a lot of money in a stock, take low risk, you got to take that opportunity. And that's just what it is with American Express. So I could continue to buy American Express on and off for years to go in the future. It's not like this is like, oh, I just got to buy it this month. I could buy this stock on and off for years to go in the future and feel very comfortable holding that stock, okay? Next up here, elf on a shelf. Or shall we call it elf fell off a shelf? Maybe, okay, something like that, okay? So elf, what's going on here? Okay. D-grade income statement for elf here. Not good, okay? Revenues look good. Net sales up to 343 mil from 301 mil, right? Gross profit went to 238 mil from 214. SG&A increased dramatically year over year for the company, 231 mil versus 186 mil. Operating income went down to $7.7 million from $28 million in the same quarter last year, right? Also, they had an other expense in the quarter of almost $2 million versus the previous year's quarter. They had a other income, basically of $3.8 million. They're just getting hit by everything. Interest expense hit them hard, $9.1 million interest expense versus $3.7 million. Net income fell to $3 million from $19 million. Diluted EPS fell to 5 cents from 33 cents. So it was just like, I don't want to say everything that was going wrong could have gone wrong for ELF, because if everything truly went wrong, revenue and gross profit would have went down as well. The only reason this company snuck out with a D grade is because that net sales grew and because gross profit grew. If it wasn't for that, this would have maybe been an F grade-ish income statement here, because the expenses, they were getting hit by everything in this quarter, right? No, they put out their latest guidance number, all right? And for the fiscal 2026, which they're now moving into. And they're guiding for 18 to 20% revenue growth. Now, some people are looking at that and they're like, that's it? They're like, that's it? ELF going up on price of the products, right? We know sell-through is very strong. They have international expansion. And additionally, they're going to have a full year of the Road acquisition. So people are looking at that and like, 18 to 20%, like we were hoping for more. Like we were hoping for 25 or 35% or 30% or something like that, right? Only 19% at the midpoint? I don't know. Like, we wanted more than that. And I can completely understand that, but you got to understand something deeper here that's going on, okay? Listen, ELF just missed revenue estimates the second quarter in a row, okay? That's not good. Terang doesn't ever like to miss revenue estimates. And he just missed them twice in a row, okay? They missed this quarter by $21 million, and they missed last quarter by a very slight amount, okay? Now, look at prior to these last two quarters. Beat on revenue. Beat. Look at how many quarters. How many quarters did they beat revenue in a row? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, at least 19 quarters in a row. At least 19 quarters in a row, they had beat revenue. And now they missed it 2 straight quarters. So if you're Terrain and you're the management team, you're a CFO, you think you're going to come in and put some big number to potentially end up missing in the end? No. You're going to put out a number that you're extremely confident, regardless of what Trump does and the tariffs and the blah, 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 and the government shutdown, regardless of everything in the world going on, you're going to come in and beat that number. That's what type of number you're going to put out there, right? Because we know Terrain and the team, they like to beat numbers. They don't like to miss. It's embarrassing for them to miss, and they missed 2 straight quarters, right? So that's what's going on there, okay? Now, so basically the moral of the story is I think they're going to do way better revenue growth than what they posted. 19% midpoint, they'll probably blow that away, okay? We'll see. Maybe they don't. Maybe they just keep missing revenue. Maybe Elf's done. They just miss forever and ever. I don't think that's the scenario, okay? Next thing you got to understand is a little bit deeper about Elf stock, okay? It's very important everybody understands this. Listen. Elf stock is one of the most volatile stocks you'll see in the stock market. And it's kind of confusing because it's a cosmetics company, beauty company, and you're looking at it and you're like, how could this company be this volatile, right? This company goes IPO kind of toward the end of 2016, right? IPO somewhere very shortly after in the $20 to $30 range, high 20s to low $30 range, right? You know what happens over the next couple of years? The stock goes to $7. That's when Jeremy Lefebvre steps in and buys it, right? I still have my $7 shares in the public account today, right? Then the stock goes on to 2x, over 2x, essentially. It goes on an epic run all the way up to, $15 to $20 a share. Massive run. Then you know what happened after that? Elf stock crashed all the way down to about $10 in the Rona crash. You know what happened after that? Stock skyrocketed over the next year or two, all the way up to $30 a share. You know what happened after that? Stock crashed all the way down to $20. You know what happened after that? Stock went on a historic run from $20 to $200 over a couple year span. You know what happened after that? Stock crashed all the way to $49, which is where it was at in the Rona, or in the, not the Rona lows, in the 2025 lows of this year back in April. Go look at Elf stock. It was at like $49 a share at the lows, somewhere in there roughly, right? So it goes from 200 down to 50. Then it bounces strong all the way up to 150, and now the stock crashed again, and I don't know, after hours it's somewhere between $90 and $100. But what can you take away from this? Okay, what can you take away from this, ladies and gentlemen, from this company? It crashes a lot. It skyrockets a lot. But guess where it goes over the long term? Up into the right. Terrain runs this company on a phenomenal level, and it goes up into the right. And so this crash that we're going through now, right, in the end, it's not going to matter. Just as we don't think about the $20 crash anymore, or when it crashed to 7, or when it crashed to 10, right? Or when it crashed earlier this year to 49. It all just becomes a kind of a blip on the radar. Because at the end of the day, if Elf really executes on a high level in this company over the next 3 to 5 years, the company is likely going to be a $300 to $500 stock. They're going to become a cosmetics giant, as in one of the biggest companies in the world over this next 5 to 10 years in the cosmetic space. Like, they have a great opportunity for that, to displace some of the biggest brands in the world, right? And so it is what it is, man. Like, as far as the stock in the short term, like, it's just another one. Like, I've been in the stock for years. This is all the way back when I bought, right? Look at how many crashes I've been through. Never mind all the corrections that you hardly even see now on this, right? Remember all these corrections the stock has had? Like, countless corrections. Some were severe corrections, and then had a multitude of crashes. Look at how many have happened over the years. I've dealt with at least 4 now. I've dealt with at least 4 crashes in Elf stock now since I got into stock, years ago. And I've dealt with, 20 corrections in the stock and probably 50 pullbacks in the stock? Like, whatever. Like, it is what it is in regards to that, right? No, this is a message I gave the private stock group yesterday, right? I said some noobs are already worried and scared with the NASDAQ down 2 to 3% from all-time highs. I said, imagine we get a 10 to 15% drawdown. They'll be in full-blown panic mode. Some folks would never make it through Q4 2021 to Q4 2022 drawdown of 37% in the NASDAQ, right? Only the strongest survive. The thing you got to understand is, and I think this is a great time to talk about this, right? Because I looked after hours and I was like, man, stocks are just getting obliterated all over the place. Like Pinterest, I think, was down 20+%. Duolingo was down like 20%. Robinhood was down. Obviously, Honest stock was down over 10%. Elf stock was down 20%. And so I was like, in the market, right, you got to understand you're going to go through some very severe crashes, corrections. Some are going to be in the whole market. Some are going to be in your individual stocks. Diversification matters significantly. So if you have, because sometimes there's going to be some stocks in your portfolio that just suck. They're just not working out. That does not mean that was a bad investment. That doesn't mean they're not going to work out over the next few years, but they might be going through something short term that you didn't foresee it being that bad, right? And you can't bat 100% in this game. You're going to be wrong sometimes. You're going to be wrong about the short term of your company's businesses sometimes. Sometimes you're going to be wrong about the long term. And you'll hold a stock for 3 or 5 years, not make money on it, and realize it was just a dud, right? And it just wasn't meant to be. That happens. That's a cost of doing business, right? You know, I'm not going to flex. I don't want this to come across as flexing, okay? But I'm going to tell you a little bit about me. I started in a 1-bedroom apartment when I moved out of my parents' house. And then I moved to a 2-bedroom apartment, and then a 3-bedroom apartment. Then I rented a house. Then I bought a house, right? And I bought another house and bought another house. And now I live in a $3 million plus house. And I'm building a $5 million house right now, overlooking the city. And that's over 17 years of grinding. And you know how many crashes I've been through over that 17 years? Oh my gosh. If I had $1 for every stock that has crashed for me, I would have enough to build a $7 million house maybe, or a $10 million house. It'd be ridiculous. It happens all the time. Every year, I'm going to have some stocks in my portfolio that crash. It's a cost of doing business. Sometimes I'm going to have stocks that don't work out, and I'm going to sell for a huge loss. Cost of doing business. Do I sweat it? Nope. Because it's the cost of doing business. You can't have, I just showed you guys, Revolve is a 7th active position. Not even all the ones I sold off over the years like Tesla and all the others, right? 7th active position in the public account that has a triple-digit gain. How do you think I get the triple-digit gains? I got to go through the pain too. You don't get those insane gain stocks without going through pain in other stocks. If I'm going to buy a stock that's going to go up 2,000%, I might end up screwing up another stock that goes down 50%. So I put $100,000 in one stock, goes up 2,000%. My $100,000 becomes $2 million. Put $100,000 in another stock. I screwed up, got it wrong. It goes down 50%, right? Completely crashed. And that 100,000 went down to 50,000. That's fine. That's fine. It's the cost of doing business. And so you got to understand, like, as long as you're doing the right things when it comes to judging these companies' fundamentals, income statements, balance sheets, cash flows, P ratios, running your projections on 1000xstocks.com, all that good stuff, right? Making sure you're paying a fair PE, making sure you're running your compounded annual growth rates, right? And trying to figure out, okay, is this stock actually a buy? How high a risk is it, right? And keep in mind, if your bear case for a stock looks pretty ugly, then that bull case better be really, really dang exciting. Like I showed you with AMD, right? I think AMD comes with certainly plenty of risk over the next 4 years. But guess what? AMD also could be one of the biggest gainers of big tech over the next 4 years. Like, would I be shocked if over the next 3 or 4 years, AMD was the best gainer of big tech? I wouldn't be surprised at all. I'd be like, oh yeah, I could have saw that, right? At the same time, if AMD was like a flat stock for the next 3 or 4 years, would I be shocked about that? And I'd be like, no, it was a possibility. That was a 10% probability. That could have happened as well, right? So that's the name of the game. And you just grow and grow and grow over time. But there's no way you can play this game without pain. You can't have the success without the pain. Ask any athlete that's been successful at their sport. Guess what? There's a lot of pain that comes along with that. You know how many losses they have to take to get that championship? You know how many hard training sessions they have to go through to get that championship? There's plenty of pain. But if you aren't willing to deal with the pain, you'll never get the gain. And you'll never live the life that you want to live, your dream life, whether that be to live in a certain type of house, whether that to be drive a certain type of car, whether that be to retire early or, retire family members or give lots of money to charity, right? I can't wait I'm looking so forward to December because every December I give to charity, right? And then, far majority of my money, 90% plus, if not 99% of my money will be donated to charity when I die. So, what are your goals? You're not going to be able to achieve your goals if you're not willing to go through the pain. There's no doubt about that, man. You'll never live that sort of life. You want to eat at certain types of restaurants. You want to go on certain type of vacations that you always dreamt of. Like, man, I wish I could go here, but I can't go there because, I don't have the funds for it, right? Man, I would love to retire my parents, but I just can't do it because I don't have the money for it, right? I want to do this, I want to do that. I want to pay for my kids' college, but I just can't do it because I don't have the money for it. And I want to set up my kids up for life, and I just can't do it for it. Like, all these things that people want to do, they can't do because they're not willing to go through the pain. You got to be willing to go through the pain. And the pain is also doing all the research work on these companies. You know how many late nights I've spent to 1 a.m., 2 a.m., 3 a.m., listen to conference calls, running projections, trying to figure out, thinking about these companies inside and out. Okay, am I missing something here? Well, what if this happens? How am I going to play this? Okay, if this happens, am I going to buy more of the stock? Am I going to sell it? Am I going to hold? What am I going to do? Gosh, it's a lot of work, a lot of pain, but you can't deny the fact that, like, the dollar amount's there, right? And your dreams are there, your financial dreams, right? I mean, there's a lot of people that want to have more kids and literally refuse to have kids because they can't afford it. That's sad. So it's either you go through the pain, the work, to get to where you want to be long term, right? Or you don't, and you never live your dreams. Let that sink in for a moment. What do you choose? Some people say, you know what? I'm not willing to go through the pain. I'm not willing to go through the work. Yeah, I'll never live my dreams, but at least I won't have gone through that pain. That's just a life I can't live. There's never been a life I could live. I made a decision 17 years ago that I said, the life I want to live is the one where I do the things that you only get, from my understanding, correct me if I'm wrong, you get one chance at this thing. You get one chance at life, right? So in that one chance, you better take advantage. Because last time I checked, we ain't coming back. So if you have things you want to do in this world, you got dreams, you want things you want to experiences, be in that moment and be like, dang, man, like, I really did this. Like, I can't believe I'm here right now, like, doing this thing, right? You better put in the work. You better go through the pain, or you're not going to be able to get that experience you want in life, right? And as humans, like, the biggest thing that I think always keeps us going is one day achieving our dreams. And everybody's got dreams. If you don't, that's kind of a sad life, right? Everybody's got dreams. Everybody's deep down. Like, some people know what it is. Like, oh, I want to do this thing, right? Some people, you got to dig deeper. It's in there. You just got to dig deeper a little bit, and then you realize, oh, they got, like, all these things they really want to do in this life, right? All these things they want to achieve. And so anyways, just some thoughts on that, okay? I appreciate you guys joining me. Hope you enjoyed today's beast video, 47-minute beast, okay? Pin comment down there will be to apply to join private stock group, private wealth group, take your knowledge up to a much higher level than where you're at right now. Join 6 and 7, 8-figure investors and all that good stuff. Get your Steel membership card sent to your house, and yeah, take this stuff serious, okay? All right, guys, much love and have a great day.